We got a debt crisis coming. It's not an if. We got it coming. The only thing you can do about it is be in the best place. So cash, to me, is gold. So like when, for example, if I get the move that I expect to get in silver, which is my emphasis now, I own very little gold. It's mostly silver miners. If I'm getting out this summer sometime and silver's up in the zone I expect it to be in, I'm not going to go to cash. I'm going to exit silver because it will have done its thing for a while, and I'm going to move it over to gold bullion. Gold will be in a new reality as well. It won't be as dramatic as silver, but again, it holds its value, especially in the kind of environment we're facing. I prefer to have a stock market top, without a headline. You go back and look at the prior ones, and you'll say, but the public wasn't really aware of why it was rolling over. And it was maybe 6 months to a year off the top before you finally started getting stories that people said, gee, I didn't know that. And yet there were people who knew it. You know, you've seen the movie The Big Short, okay? There's a handful of guys scattered around the U.S. who in the financial markets, but were laughed at by their peers, who knew we had a mortgage crisis coming. They knew it a couple of years ahead of time, 2005 and 6. Market didn't top till October 2007. But they were right. They knew it was coming. And it was bleeding obvious, except people ignored it. Well, this is bleeding obvious, and people are to some extent ignoring it. The Fed isn't, because they're buying bonds. But once you jar that bond market price-wise and you spike yields through that congestion zone of high yields we've had, you're going to wake the public up then. Our suspicion is, or expectation, I should say, based on momentum factors. And we did expect this rally, by the way. Though we think it's a topping process, we said back in November, this market's got to go up again. The technicals weren't ripe for a continuation down. And so when that war started, it made slightly lower lows in the S&P than it had in the prior few months. And we said, no, you got to go up. The technical said you need to. If you're a bear, you want this rally. And sure enough, we got it. We think it's setting up so that probably in the next quarter, meaning April, May, June, get into July, the S&P could be at some major trigger points that you don't see on a price chart, but we see on our momentum charts that could precipitate a fairly rapid decline. But goodness knows where silver might be by that point in time anyway. Crisis that causes a total rethink of that asset category, both by the investors who invest in it, thinking it's a comfy place to be over generations, which it's not really, but also institutions will begin to doubt certain things because this crisis will have political ramifications.
Government bonds used to be safe, but that's changing fast. As yields rise, bond values drop. Central banks are trying to fix it, but if they fail, the damage could hit everyone, from big governments to everyday investors.
I'm sure if the bond market starts to roll over in price and break like we think it's in the process of doing already, though it's in slow motion right now, and a rise in yields, there'll be a point at which you get a panic where people suddenly say, oh my gosh, what's going on here? And the Fed already sniffed this out back in November. That's why they started buying bonds. It wasn't to provide liquidity. It was to try to hold that market together. And so far, it ain't working. Yeah, it's not collapsing, but it just keeps oozing. It can't seem to get off the bottom. And our technicals argue you've broken enough momentum factors to argue the price is going to go down soon, too. Yield is going to shoot up. Once that becomes a smack in the face for the average investor, then, being in that category is not a place to be. And if the stock market is also turning down, well, heck, where do I go? What you're left with, monetary metals and broad commodity complex, by the way, as well. But
what about cash?
Well, no. Cash will lose value because if it's $1 or a yen or a euro, its buying power is going to degrade rapidly because the central banks will expand the money supplies. But
like in the immediate term,
it's always a way to park it. But my definition of cash is gold. Mm. It's the money that never loses its value over the long term, period. It doesn't lose its value. That's why, 4,500, 45,000, 450,000 for a house. Okay. Or you can look at a loaf of bread. It's a bit lagged to that. But a lot of assets have gone up in price. Why? Because they're bull markets? No, the degradation of the money unit. It's the yardstick itself is depreciating. And therefore, it's nominal prices that you assign to various assets. They go up. That doesn't mean that you're really making money. If you bought a stock 10 years ago at $10 and it's now 20, you're not really making money. Money supply's grown almost that much. We got a debt crisis coming. It's not an if. We got it coming. We have to deal with it. Well, the only thing you can do about it is be in the best place. So cash to me is gold. So like when, for example, if I get the move that I expect to get in silver, which is my emphasis now, I own very little gold. It's mostly silver miners. If I'm getting out this summer sometime and silver's up in the zone I expect it to be in, I'm not going to go to cash. I'm going to exit silver because it will have done its thing for a while. And I'm going to move it over to gold bullion. Period. Gold will be in a new reality as well. It won't be as dramatic as silver. But again, it holds its value, especially in the kind of environment we're facing.
Would you also position yourself into gold and silver mining stocks? Or?
Oh, yeah. I'm about split even on silver and silver miners. I do own some GDX, but my preference is now when we run a spread chart, again, let me explain that again. That's when you measure one asset versus another relative performance, okay? And you go back to 2020, for example, and you plot SIL price divided into GDX price, silver miner ETF versus the gold miner ETF. The GDX does hold about 20% silver miners, by the way, but it's still called the gold miner ETF. But if you divide SIL into GDX, SIL had a huge move up in 2020 when silver and gold had big moves up. But its relative performance dropped back down relative to GDX in 23, 24, 25. It dropped and went sideways, where it had lost value relative to the gold miners, but didn't lose any more. It just went sideways in a boring range of relative performance readings. It broke out of that range technically last year, in the last quarter of last year, and surged since then relative to GDX. So technically, that spread relationship is arguing you want to own silver miners over gold miners. They're likely to outperform. And that's reflective of the same thing that happened to silver to gold. Silver's broken out versus gold. Silver miners are broken out versus the gold miners. So my preference is the silver side of the monetary metals.
As trust in traditional markets fades, people are turning to physical assets like gold and silver. Unlike paper money, governments can't just print more of them. Silver might be especially profitable right now because of its growing demand.
Well, the CPI, I don't view it as inflation. It's a reflection of inflation. Okay. Stock market can also be an inflationary indicator. Meaning when the Fed prints money and they do it in waves often, where there's more and then there's a little less printing and then there's more printing, especially during times where they perceive a crisis in an asset that they don't want to go down, like the stock market or the bond market. They don't care if corn goes down or wheat goes down or sugar. That's fine. Hell with those guys. We don't care about them. But when that stock market tops and you get trouble in the bond market, they'll print like crazy, more so than they have ongoing. And that money goes somewhere. That's inflation, is the increase in the money supply. Sometimes, like from 2009 to the present, the stock market has been a prime beneficiary of the ongoing monetary printing. And so when the Fed came in, like in the COVID crisis, and went apeshit, S&P went vertical as well. It got the drug infused with some new money. Okay. And even the Fed was buying ETFs then. They were buying the bond related ETFs. So they were actually in the market bidding up assets. So that's inflation also. It's not just commodity prices. Stock prices can reflect the inflation in the money supply. But then there's times it shifts where they can keep inflating the money supply, but the stock market says, no, I've gone too far. I'm going down anyway. You can print all you want. And that money gets printed, rates get cut, but it doesn't have the impact it had like in 2009 when they went to actually it was in November of 2008, they went to QE. And about 6 months later, the market finally bottomed and started to turn up. That's inflation, is the monetary aspect. The M2 chart is inflation, and it shows itself in different markets at different times, and they can rotate. So sometimes the investor decides, hey, this has been great for 16 years in the stock market, but I'm going to move my money over to something that's doing better. My buddy down the street bought gold 2 years ago, and he's smiling pretty good, so I'm going to do the same. So the money moves, and they can create more inflation, but it isn't reflected necessarily in the stock market. I think right now what you're seeing in wholesale prices and consumer prices is going to be reflective of what we're going to see in commodity prices. If you look at the Bloomberg, Bloomberg Commodity Index is a well-balanced commodity index. Oil is not some overweighted component. It broke out by our metrics on momentum-based. Annual momentum broke out to positive back last October, well before this war ever broke out. Bloomberg then was 106.50. Right now, Bloomberg's 140. It's a pretty good percent move. October closed Nov, Dec, Jan, Feb, March, April. Okay, in six months, it's gone up that much. Woo! And yet it's not garnered headlines. But it will ultimately reflect in those other, quote, inflation metrics. But the Fed's going to have a real problem then, because if they say, well, we can't cut rates because, quote, inflation's high. Well, hell, inflation's high all the time anyway because of what they do, the monetary expansion. It just goes in different places. They don't like it going into CPI. If they don't respond to that, they got a problem, because then how are they going to defend the bond market?
Rising stock prices don't always mean you are getting richer. When the government prints more money, asset prices go up, but your actual buying power drops. Don't be fooled by currency devaluation disguised as true value growth.
They twiddle their thumbs and say, well, we can't cut rates because the CPI is over our target. Yet their monetary growth continues. Gold knows all this. It's not looking at CPI, nor is silver. The Fed might be claiming that they are. But remember, they got the dual mandate. Right now, we're arguing at MSA, the real crisis for the Fed is not that commodity prices. They're going to have to just squat and forget about that mandate, because that government bond market gets into trouble in a more obvious way. They've got no choice. Oil has lagged to the commodity complex because we had a buy signal on Bloomberg back in October. Oil didn't break out then. Our metrics had oil break out at the January close, 4 months later. Oil then was crossing through $63. And we got a buy signal at the close of January, which was $65 on West Texas Intermediate. Unfortunately, the justification for that, by the way, for an upturn, is that commodity prices are historically low relative to their own history. They're low relative to the stock market valuations. You run a spread chart of the Bloomberg versus the S&P, and you'll see something that looks like, gosh, that's free. That asset's free. I'm going to buy it. Okay. There's zero risk anymore. It's starting to come to life. And I think what it's reflecting is the beginning of the asset class shift by investors and asset managers from a bloated asset category into one they perceive to be less risk, more reward potential. And so far, if the guys got in October, they're doing pretty darn well with the Bloomberg Commodity Index. And by the way, it got up to 140 well after that October breakout. It got there well before the March beginning of the war, the end February beginning of that war. It had already gone up to 130 to 140 anyway. And oil was lagging as a component. The news overheated oil. And so what we argue to our subscribers is, yes, as a broad category, commodity assets are a place to be. They're not going to do as well as gold or silver, but they are an investment grade, cheap asset category to participate in. You don't have to leverage it. Don't buy calls. Think out a couple years. Buy grain-related companies, like MOO is an ETF of agricultural-related companies. fertilizer companies, so they've been a bit exaggerated lately because of this oil situation. Base metal miners, copper metal, copper miners, etc., and also energy. The only problem with the energy complex is that you've got that idiot buying of headline news. And once the Iran situation abates in any manner, and I still think that they're going to have a street uprising at some point that will upend the thing in 48 hours. Meaning once that begins, it won't be like the prior uprisings that were suppressed. This one won't be suppressed successfully. And that could end the whole situation because then the war is inside of Iran. But once that occurs, all the people who chased the war headline didn't buy it back in January at $65, like we said, but bought it at 95. They're going to get gut kicked. It doesn't mean that oil is going down. It just means oil could have a sharp correction within this new emergent uptrend. And maybe you drop oil back into the 80s or something to correct for the headline chasers. It's just like a year ago, January through April of 2025, the stock market went down what? Based on a sudden new headline, tariffs. Hadn't been a subject in the markets for any time. Suddenly Trump comes there with tariffs. Oh, it's the end of the world. So they sold the stock market. Okay, look what happened to them. They got cut in half. The market exploded against them. So anybody who sold the headline, anybody who sold the stock market based on the Iran war got gut kicked already. And those who bought oil based on that could get gut kicked on the downside. So I think oil is a place to be, but I'd rather wait for a nasty sell-off.
True inflation starts when the money supply grows, and right now, that money is flowing into commodities. If consumer prices keep rising, central banks will be trapped between fighting inflation and trying to save the financial markets.
The Ukraine war started, the Russia-Ukraine war in late February 2022. Yeah. At that point, oil had a peak at 130. Bloomberg Commodity Index was up at 140. The war began, and you think, oh, global uncertainty, that should be good for commodities. They collapsed. Oil went down during that time and stayed down. Commodities went down. So people who bought war news then, it didn't work. So people who are buying anything now based on the war news or selling anything now, like they sold gold and silver, for example, are going to find that it doesn't work. Well, and even though the war is not abated, at least as we know it, silver and gold are recovering. They're saying, heck, that's noise. It destroyed, fortunately, the popular myth that gold goes up on global uncertainty. I see that on financial internet, like CNBC, that gold's down today because global uncertainty, it went up. It should have gone up because of global uncertainty. No, it shouldn't. That's not what drives gold.